All right, we got a latest glimpse into the U.S. economy this morning. The Labor Department releasing the jobs report for the month of June. It shows U.S. employers added 213,000 jobs, a little better than expected. However, the unemployment rate rose to an even 4%, up from 3.8. We want to discuss it with Rachael Aiken with Rockland Trust. Rachel, it's great to have you here. I hope you had a good holiday.
Thank you, Brian. Good morning. Yes.
So what do you think of this report? Some mixed signals. The wage issue is not resolved either. People are not making as much money as you would think if labor's in such demand. What did you think of the numbers?
So actually, it was the best of all worlds. When you saw job creation in excess of 213 jobs, when we were only anticipating 193, that was super, and it indicates strong growth and a strong economy. Also, looking backward, we had revisions upward for the 2 prior months that show for the year we're averaging over 200,000 jobs.
And people have to understand, too, the unemployment rate it is important to show trends, but there's also a healthy reason why it went up, because more people entered the workforce. Isn't that right?
Absolutely. So the other part of it being almost a Goldilocks type of report is that wage inflation was relatively tame, up 0.2%. Unemployment went up 4% because we have more people entering the labor force, which shows there's still slack, which will continue to fuel growth and consumers.
And there are so many people who left the workforce during the Great Recession. Maybe some of those people are getting a little more interested in what's going on. I want to ask you, because today the United States supposedly started the trade I don't want to say war, but the trade issues with China in effect today, and China responding. The market has been sensitive at some points to it, other times it ignores it. How big a problem do you think, A, for the market, but B, how big a problem is it for the economy?
So when you look at the numbers, the actual impact for our economy with the tariffs that we have in place before today, including those that were implemented at midnight tonight, or yesterday, excuse me, are relatively small.
Right.
So at that point, we don't see a sizable effect, maybe 0.2 of a decline in our GDP or economic growth. The real concern is longer term. If this continues to go on and there's an escalation and more tariffs and trade restrictions are placed, it could have a very deep impact on our economy, but longer term.
Right, so that's the economic part of it. Are your clients literally calling you and saying, what do I do? Is this something I should sell on? Because the market's come so far, right? Probably people looking for a reason to take some profits.
So we've had many tries to run back up to the January highs that we experienced, and clients have had more volatility this year than obviously we faced last year. We have had clients who, when we talk to them about kind of tuning out that noise and focusing on their long-term goals. To use a driving analogy, stay on the road to your long-term destination and don't get sidetracked, don't take that off-ramp as far as trying to time the market, but it's always prudent to take gains and stay properly allocated.
We're pretty much out of time. Just quickly tell me, do you think the market trend is still higher in the short to medium term?
There is going to be strong momentum in the economy from fiscal stimulus, tax cuts, and regulatory rollbacks that will continue to push corporates' profitability higher, but we do need to keep an eye on what trade will do to corporate profitability and consumer spending.
Rachael Aiken from Rockland Trust, thank you so much. Joy, back to you.
Thank you.
Thank you so much.